What is implied volatility? Brought to you by Bullring Trading. Implied volatility is a key concept in options trading that measures the market's expectation of future price movement. It doesn't predict direction, up or down, but instead tells you how much the market expects an asset to move within a certain period. 1. What is implied volatility? IV represents the market's expectations of future volatility. Higher IV means bigger expected moves in the stock price. Lower implied volatility means smaller expected moves in the stock price. Think of IV as the price of uncertainty. When there's uncertainty or big news like earnings, IV rises because traders expect bigger moves. 2. How implied volatility affects options prices. Higher IV means higher option prices. When IV is high, options are more expensive because traders anticipate big price swings. Lower implied volatility means lower option prices. When IV is low, options are cheaper because the stock isn't expected to move much. Example: if a stock normally moves $1 per day but suddenly has IV rising, it might be expected to move $3 per day. This makes options more expensive. 3. Implied volatility and earnings reports. Before earnings, IV is high because traders expect a big move. After earnings, IV drops, called IV crush, because the uncertainty is gone. If the stock doesn't move much after earnings, options can lose value even if you predicted the right direction due to the IV drop. Example: a stock has high IV before earnings, but after the report, it barely moves. The result? Option prices drop, even if the stock moves in the expected direction. 4. How to use IV in trading. High implied volatility, consider selling options. When IV is high, options are expensive. Selling options, covered calls, credit spreads, can benefit from an IV drop after uncertainty is gone. B. Low implied volatility, consider buying options. When IV is low, options are cheaper. Buying options, calls, puts, is better when IV is expected to rise. 5. Key implied volatility indicators if rank or IVR compares current IV to its past one-year range, 0-100 scale. IVR above 50 means IV is high compared to the past year. IVR below 50 means IV is low compared to the past year. IV percentile measures how often IV has been at or below the current level over the past year. 6. Practical trading tips. Buy options when IV is low, before a big event or breakout. Sell options when IV is high, to collect premium and benefit from IV drop. Don't hold options through earnings without understanding IV crush. Final thoughts. Implied volatility is a crucial factor in options pricing. Understanding it helps traders time their trades better, avoid overpaying for options, and take advantage of market expectations.